Hi, it's Larry Gaines, PowerCycleTrading.com. In this video, I want to show you a setup that we did for Facebook using a calendar diagonal spread. So this particular chart pattern, you can see we had a big high back here in July and then a low, and then you can see Facebook's been bottoming out, finally back above the 618 retracement here. We've got what we call volatility squeeze on the daily and also on the weekly. So this has really good potential for a bigger, powerful move to the upside. So we did a calendar diagonal to take advantage of if the thing kind of stalls in here towards 200 and then gets going. So we can eventually, kind of like a covered call, we can sell out of the money call against this position and then amortize down the cost of our long dated options. So let me show you what this kind of looks like, and it gives you a lot of different options or flexibility as to what you can do with this current spread. So we're looking for an initial push to 200 right in here. So we set up today the 17 January series 195 call long dated at around 785, and then sold against it the December 20 $200 call. So if you look at that, it looks like kind of a call debit spread, the 195 200. But the difference here is that we have the long dated 195 call way out in January of 2020, and then we sold the call against it in December 20th call series there. So it looks kind of like a call debit spread, but we're selling the closer in series to take advantage of faster theta decay, but have a vertical kind of debit spread setup component to it. So if this, for example, was to go out, let's just say tomorrow, if it rips to the upside tomorrow Tuesday and goes to 200, this trade will be up $60, and that'll be about a 13% return on our risk of $465. So kind of like a covered call, but instead of buying the underlying stock security or the security itself at $197 for 100 shares, we bought the 195 long dated call out in January 2020. So what we can do is you could take profit if it went there, or if it, let's say it goes to $200 on Friday the 22nd, this will be about 68.65, so it'd be about 14% return. So kind of similar to, much better than a covered call. But the other beautiful thing about this type of strategy is that the other thing we can do is, instead of closing out the trade, taking profit, we could just close out the call that we sold, that 200 strike, set that up at 720. We could close that out. We could take a potential loss, readjust up this, and then sell further out of the money, or we could close this out and just stay long the long dated 195 call and get a potential for a powerful run up, or just leave it alone and see where it goes. So for example, if we were to leave it alone, let's say by the end of next week, the 29th, it's trading up here at 200 or 203, this will be up $90 to $120. So it just gives you a lot of flexibility on this type of strategy, and hope you found it of interest. And if you'd like to learn more about calendars and calendar diagonals, I'll be doing an encore free webinar tomorrow night, Tuesday night, on this strategy and a lot of other income strategies. So join us if you can. I look forward to seeing you, and good luck trading.